All right, welcome back to the Tim and Tim Show every Tuesday at 10 a.m. Eastern Time. This week I'm flying solo. Tim Vest is on the road, meeting with some of our employees on site, on location, doing the boots on the ground work, as they say, driving properties and meeting with the team, and trying to problem solve and kick the tires to make sure everything is operating the way that we expect it to be operating, and presenting the way that we expect it to be presenting. So in the essence of trying to cover a lot of ground, we're splitting duties today. He's on the ground, and I'm doing our show live today. So I figured I would take this opportunity to talk about underwriting again. I feel like this is something that is ever evolving and ever continuing. And even when I was thinking about doing the show, I had some reflections back on how my underwriting used to look and what my level of aggressiveness used to look like even a couple of years ago, and to how it's changed in the last 6 months. How's it changed in the last 2 years? It Just because you're underwriting one way doesn't mean you're going to underwrite that way forever. And so there's obviously some key checkpoints that you want to make sure that you're hitting, and kind of broke it down into, like, 5 things that we look for, pay attention to when we're evaluating a real estate deal, right? At the end of the day, it's high level. First, we're checking the market and the location. Then we're going to check out the financials and actually do the underwriting process. Then we're going to check out the debt and the capital structure, and key in on that a little bit more. Operational upside: what opportunities do we have to force the appreciation and the value, and more significantly, the cash flow on an asset? And 5, what's our downside stress test? So we're going to go through all of those different things, and I'm going to try to talk as candidly and in depth as possible as each one of these different um, steps, or steps in the process, because it changes, right? My appetite changes and what I'm looking for changes. And so, first things first, market and location. uh y- when I first started out in the real estate industry, commercial real estate industry, I was looking for any deal in a major metro, right? That was a problem because I was looking for deals all over the country and I didn't know what I was looking at. So one of the first things that we had done was kind of draw like a 4-hour circle around Charlotte, where I lived at the time, and said, okay, I'm going to buy deals within this 4-hour window here, which basically is almost all of the Carolinas from Charlotte, right? So you're hitting Raleigh, Greensboro, Winston-Salem, Asheville, obviously Charlotte, Columbia, Charleston, Florence, Myrtle Beach, Wilmington is a little bit on the outskirts there, but generally in Greenville, South Carolina, another great market in North and South Carolina that we were looking into. So once we once we started to do that, we started to buy deals, and now that we own a lot of deals that are scattered throughout all of North and South Carolina, my new check in this process is: do I already have an asset in this city? If yes, I'm way more interested in it than a city that I don't have an asset in, because multifamily operations is all about economies of scale. And we have a lot of like 30, 40, and 50 unit properties that are scattered through a lot of tertiary and secondary markets in the Carolinas. We do LIHTC affordable housing. So that's just kind of the nature of the beast. But that also that gives us our competitive edge, right? We might own a 40 unit property down the street. We might be finishing up on a um, we might be finishing up on our value add plan. And now what we're going to try to do is say, hey, this property is going to be stabilized. Let's go add another one so that we can reduce our operating costs at this property, and then also go out and buy another property and have that economies of scale. Ideally, we're looking for 100 to 150 units in a single market. That way we can have either a solid property manager with maybe an assistant manager, and two, maybe even 3 maintenance guys. And a lot of you guys might be saying, well, that's too many to have 150 units. But when you have smaller properties that are a bit more scattered, you lose a lot of time to driving. So you have to consider that your 2 maintenance guys that would work on a singular property of 150 units are very successful. But if it's scattered across 3 different locations, you lose a lot of time going in between those locations and doing supply runs and stuff like that. So we just have to factor in our payroll costs are going to be a little higher due to the way that we're set up to run. When we're looking at markets, not only do we want to buy something in a market that we already own something in, we also want to make sure that the market's growing, that the population's growing, that the job growth is growing. I mean, very basic real estate fundamentals, right? Um, why is that important with LIHTC? When hey, good morning, Russell. Sorry, Dennis. I was looking at your last name, Dennis Russell. Um, Russell, the love muscle. When you're looking at real estate deals, especially with LIHTC, you want to make sure that the all three of those are growing. It's important for LIHTC because when every year we get our rents analyzed based on the average median income and the average median rents. So if the average median income and the average median rents are going up, then our rents too will go up based on an allocation percentage that's completed by the housing authority. If the population is declining, if the average median income is declining, then our rents are also going to have to decline in order to match that same decline. So markets like Charlotte, for example, we have a property in Charlotte. The rents grow astronomically every year. What we found now, the problem is in Charlotte that the rents have grown so much, the people that can afford to live in these properties can't afford that level of a rent increase because they are so much further below the AMI. All right, so like hypothetically, you could have somebody that's living in a 60% unit, which is the highest set aside that we have at our properties. And with a rent increase, they might only qualify to live in a 50% unit. Well, if they're in a 60% unit and they can't afford the rent for a 60% unit, and you don't have a 50% unit to move them to, you have the possibility of not being able to retain that tenant because their income didn't go up with the averages as much as everyone else did. So, a couple things that we've learned through owning and operating our LIHTC deals, our affordable housing deals in the Carolinas. But yeah, job growth, population, those are obviously two major economic factors. And then do we already own something in the market? That really drives it for us. And we use that as a bargaining chip with a lot of brokers that, hey, we own XYZ property down on XYZ street. And we want to add to that market. We're solid buyers, we're in-house management, we're done with this value add deal, we're looking to add on to something else. So that goes a long way when you're putting in offers with brokers. Um, so that's kind of like the initial check. The second step after that, financial review. This is the actual underwriting of your NOI, income, expenses, analyzing how the property's currently operating, how you think you can operate it, and is it something that you think you can make money on? Do you, at first pass, are the rents low? Are the expenses too high? Does it need significant capex in order to achieve those level of rents? This is really nothing that is there's nothing that's it's no new information here, guys, right? Like this is just doing the actual underwriting of your income and expenses. Focusing on operational efficiency and how can we operate this property compared to somebody else. And I'll let you know something that there are a lot of deals that we look at that we are not the cheapest management company in order to operate some of these deals. And a lot of it's because what we just talked about with having smaller deals in a lot of different markets and when they're not when they're kind of spread out a bit more, you run a lot more general and admin costs with travel and mileage and time lost with payroll and all this other kind of stuff. So we can be an expensive property management company to run properties in markets, and that's why it's also very important for us to continue to add and scale so that we can help the portfolio in that region continue to go down. So kind of a bit of a cat and mouse game there. So after you do your actual financial review and underwriting, then we start looking at the debt and capital structure. Obviously, banks are your number one investor. Like they'll give you 60, 70, 80% of your purchase price. They are your number one largest investor that you could secure for any real estate deal. Now, could be a bank, could be a private investor, whatever that looks like for you. But the person that is ultimately holding the first lien position, that is going to make or break your deal. And I know JD Crowell is not watching this show right now, but he actually made a really great post about analyzing debt structure and how it's the backbone of your real estate deal. And nothing could be more true than that, because the debt is what makes or breaks a deal, right? You can do whatever amount of value add you want on a deal, and if your interest rate is just eating you alive, then there's no way. It's a hard probability for you to become successful on a deal like that. Understanding your debt structure when your interest rates, if they're variable rate if they're variable rates, like, are they, going to move up? Are they going to move down? Are you willing to risk that? Me personally, we don't touch any variable rate interest rates. I prefer fixed rate debt. And you know, hey, some people might look at me like I'm crazy on not capitalizing on variable rate debt, but that's what makes me sleep at night. We had one variable rate loan in my life, and we got out of that thing in 8 months because it was treacherous. It was also when the Fed was raising interest rates 75 basis points every 6 weeks. So, hmm, yeah, you can probably figure out why I don't touch variable rate debt anymore. um, but yeah, paying attention to your loan terms. Obviously, the interest rate's important. Leverage is important. Not being over levered is also important. Uh, you know, One of the things that is I think this is a hard lesson to learn is just because your bank underwriting gets you to a 1.25 debt coverage ratio doesn't always mean that the property is going to cash flow significantly. If you think about it, 25 basis points above your debt service, right? So your cash flow needs to be, if your debt service on an annual basis is 100,000, you need to make $125,000 a year to qualify for your 125 debt coverage ratio, right? That's very simple math to understand. That's three HVACs, right? I mean, you replace three HVACs throughout the entire year, and all of your excess cash flow is completely gone. Being properly reserved is important, but understanding that just because there's 25 basis points above your debt service doesn't mean that the property is going to see cash flow significantly. And then also, I mean, how how much interest are you paying your investors, right? If you think about it, and I don't think maybe not enough people think about it this way, but when you're buying a real estate deal with other people's money and leveraging other people's money with interest, you're 100%, sometimes 105% levered, right? Because you're borrowing money with interest from a private investor as well as a bank. So there's a lot of debt on these properties that you need to make sure that you have a very clear value add plan, which is identified in your financial review and your underwriting of how are you going to make this deal cash flow and how are you going to make your investors money, because because the bank is always going to get paid. So the bank gets paid, but are your investors going to get paid? And that is what's going to separate you from a good investor from a great investor. And obviously, we've been talking a lot lately about how rises in expenses has just killed our cash flow. But in our example, it's only three HVAC units that go out that you have to replace, and your cash flow is gone. So it's a very finical thing. The margins can be really, really thin. And that's why I'm trying to put this stress on the importance of understanding and getting access to cheaper debt. We have been successful in doing that by making a lot of seller financed offers, even overpaying for a property. But as long as my seller finance offer, like, if I put a 10-year note on, generally you would think that over 10 years, you would be able to increase the value enough to cover to be able to refinance or sell that property for a profit. So when your loan, back to the loan terms, when your loan comes due, that is also important. And understanding where you are in the market cycle is important. So if I could go back into 2021 and 2022 when interest rates were like 3%, I scoffed at locking in on a 5-year loan because we were doing so much transactional deals where we were trading in and out of deals all the time that I didn't want the idea of locking into a long-term interest rate. But now I'm looking at it as, man, somebody that had been through that market cycle already understood where they were, and they refinanced into a 10-year agency loan, and they put it on set it and forget it, because that's the cheapest debt that you're going to get over a long period of time. And as the inflation continues to rise and your rents go up, your cash flow is going to increase significantly. So making sure that you're understanding your deal in terms of timeline, obviously that lines up with your loan terms and your balloon payments and everything else that has to come into play there. But don't you really have to have an understanding of what your actual annual debt service is going to be, principal and interest plus all your escrow payments, right? It goes out faster than it comes in, and it really puts a lot of stress on deals, and it can make operating deals very difficult. um, so after your so we talked about debt, right? The other side of it would be your investors. Right now, one of my mentors always told me that you're either in one of two markets. You're in the market there's deals everywhere and no money to be found, or it flip flops. There's no deals to be found and money everywhere, right? I feel like right now we're kind of in a transitionary period where there are a lot of deals coming to market. There's a lot of commercial real estate deals coming to market, a little less on the multifamily. I haven't seen a ton of multifamily stuff come to the market that we have been reviewing and offering and making offers on or LOIs on. But I think it's coming. I think the second half of this year was gonna bring a lot more opportunity. So we'll see. I don't know. Obviously, I don't have a crystal ball. Nobody does. But understanding how much money you can raise. Part of our 5-step process of evaluating a real estate deal, besides the market location, actually doing the underwriting and making sure that we can get good debt to make it a deal that's successful, is understanding, can we raise the money to do the deal? Um, Before, we had no problem raising, up to $5 million for a deal. Like, that was, not really breaking a sweat. Now now we're looking at deals that are maybe $1 million raise or even a $2 million raise, and saying, can we get this done? Because it's been so difficult to raise money over the last 12 to 18 months. So we haven't bought a deal since last September. So we're going on, geez, was it 18 months? More than 18 months. A little, maybe, yeah, a little more than 18 months now that since we've bought a deal. And a lot of that is because we have operational things that we have to focus on, which we'll talk about next, our operational upside. Um, but understanding if we can raise the money like that is really difficult in today's market. I know a lot of people in my circle. Nobody's really reached out and said, "Hey, will you raise money for a deal?" That was happening a lot over the last, 5 years, and then it's really calmed down, it's really slowed down because I think everyone doesn't have a lot of access to capital right now. So, back to underwriting, right? Making sure that you're offering your seller finance offers. Uh, I always try to offer 3 offers. One's my cash price that we're gonna, either buy it as a JV or syndicate it or however we're gonna do that. Offer number 2 is going to be if we do a seller carryback, where the seller holds back a percentage of the purchase price. That helps me on the capital raise side of things and my cost of capital, because I can generally borrow money from the seller cheaper than I can from an investor. So trying to get the seller to carry back the down payment has helped out being able to do deals. And the last offer is going to be seller finance with very low money down, but also a very low interest rate. But that's obviously going to be the highest purchase price. We've had a lot of success with that lately. Hoping to get a couple deals under contract in the next maybe 45 days or so. I don't know. We'll see. I got all my eggs in a couple baskets, 2 or 3 baskets right now that I'm going after aggressively to get these seller finance deals done. But a lot of that's based on not being able to raise the money, and with debt being expensive, trying to secure long-term debt with the seller instead of a bank. And that's been received very well. That also kind of gives you a little indicator of where the market's at when those types of conversations are being received better than they were in 2021, when everybody knew they could just throw property on the market and sell it and somebody will buy it, right? So, um, yeah. Well, hold on. Dennis, I hope you got your coffee, man. It seems every Tuesday morning we're having our Tim and Tim coffee hour, or half hour, I should say. All right. So after we have done those 3 major critical steps, then we're really kind of looking at the operational upside and what other opportunities do we have to increase the NOI, whether that's through capex, renovations, or just rent adjustments or expense control, management improvements, things like that. Um, because we own in a lot of different markets, we have a lot of data, a ton of data. For example, we have an offer in right now on a property in another market that we own. And we we were looking at the rents on Rentometer, and I was like, wait a second, we have a property manager there. So I called her and I said, hey, what do you think are you familiar with this property down the street? And she goes, yeah, I know that place. She goes, and I said, well, what do you think we can get for rents over there? She was like, what I think we can get? And I said, yeah, but then give me the I know we can get numbers. So I underwrote to the I know we can get to numbers. And having that level of data on that market is incredible, right? It really helps you dial in your underwriting and know exactly what you can get your rent increases to. And we operate in the area, so we know what the level of renovations need to be done. So it's very underwriting is way less speculative when we're buying in markets that we already own in, because we have level of data on insurance costs and capex renovation needs. More importantly, the rents, what the utility usage rates look like, right? So we have some newer product in this market, and we know what the water usage looks like. So when we were looking at the water bill, I was like, we really need to figure out if this water bill is correct, because it's either too low for it to be, for the entire property, like way too low for it to be for the entire property, or the flip side is there's a water leak in the parking lot that is causing this water bill to run outrageously. So what is it? Because it's way too high to be like a common area water bill. So having that level of operational upside is important, because you can identify with high certainty how you can operate a deal. And the more accurately you can dial that in, the better debt that you can get, the better level of returns you can offer to your investors, and it all starts to compound and it starts to stack on itself. The operational upside is having the ability to be vertically integrated with access to real-time data on other properties that you own in the area. And if you don't have that, that's okay, but you should have a circle or a sphere of influence, and reach out to some of those people that are in your sphere of influence, right? Ask them, what's the operations look like at your property? What type of rents are you getting? How bad's the delinquency right now? Is it going up? Is it going down? Are your Section 8 vouchers increasing, decreasing? What's your utility usage rates look like? On average, what's your insurance costs look like? Can you tell me how the insurance, your tax bill was reassessed when you purchased it? It's a bit more legwork to do it when you don't own something in that area, but I don't think anybody should make the excuse that they can't do it. It just takes a little bit of legwork and making some phone calls and building your network to be able to have that same level of information. It just looks a little different. And then lastly, our downside stress test. So we start assuming, what if the exit cap rates go up another 50 basis points, even 100 basis points in a 5-year period? What if a vacancy, instead of underwritten as 5 to 7%, is closer to 10 to 12%? What does that do to cash flow? What happens if rents go down and vacancy goes up? What if rents are flat for the next 2 years? Does it kill the deal? Right? Are you banking on upside appreciation of your rents over the next 5 years in order to make this deal work? So, we're kind of constantly analyzing different metrics there. I mean, obviously the big ones are going to be your exit cap rate, your debt interest rate, your rental income, your expense ratio, and your vacancy, right? Vacancy and bad debt collections. Those are all the things that you need to kind of stress test up and down and see what is some probability of how those changes could impact your deal, or positively or negatively. What I've seen a lot of people do recently is they put together like a pitch deck, and the pitch deck will have the I know we can achieve, the I think we can achieve, and the if everything goes our way and we're getting pushed downhill, and interest rates are dropping, insurance rates are dropping, and rents are going up. Like, what is the extreme case of like best case scenario? And I really like how people are doing that, and we've started doing that as well, even with our own internal conversations. With, okay, well, what if the rents are flat? What if the rents go down $25 for the next 2 years, and then they start to go up 3% a year after that? Or what if it's 2% a year? What if insurance keeps going up 10% per year? And obviously, all of these things are hypothetical in nature, but you have to explore the conversation and see how does that impact your deal. And more often than not, you're going to find that it's going to kill your deal. And that's just how it is. I mean, I can't tell you how many deals we look at before we actually get something under contract. And then once you get it under contract, if your due diligence is going to be able to withstand your due diligence process and say, we've clearly budgeted for everything. We know what could go wrong with this property. We're going to make sure that we have the money to fix it all, and my numbers still work. And if it don't, you try to retrade with the seller get the price down because it wasn't accurately, it wasn't what's the word? It's wasn't accurately portrayed, or disclosed. Yeah, they all of the issues were not disclosed, so we didn't include that in our original underwriting budget, and we got to make adjustment for it now. It is what it is, Mr. Seller. I mean, either you're going to pay for it or I'm going to pay for it, and I know sure as hell I'm not going to pay for it because I wasn't including it in my original budget. If you had told me up front that the roofs need to be done and that there was leaks in 2 of the 3 buildings, then I would have included it. My original offer price would have been significantly less. So we're constantly evaluating the downside on each one of our deals and trying to predict what could happen. We get a lot of data and a lot of information from a lot of different sources: insurance brokers, lending brokers, transactional, commercial real estate brokers, and what they're seeing in the market, what they're seeing on the backside of deals. There's a lot more distress out there than you think right now because it's not like publicly disclosed. But if you know a lot of brokers, call them and talk to them about some of the deals that they have heard of going under. And more often than not, like I know a broker specifically that thinks that more and more people over the next 24 months are not even going to try to fix or salvage a deal. They're just going to turn the keys into the bank and walk away because the spread between where they need to be on a refinance and where they are today is just so great that they can't overcome it. So they're just going to do a deed in lieu of foreclosure or get foreclosed on and just end up walking away from the deal entirely. So there's definitely a bit of fear in the market. There's could be some good opportunity coming if you have access to those types of deals. Again, your network and your relationships and trying to get access to those types of people. Good morning, Mom. I see you on here. Um, that's my mom, guys. Yeah, Kathy Vitale. Um, so yeah, so that's in a nutshell. That's our 5-step process of evaluating deals and having an understanding of whether we're going to do a deal or not. With owning, geez, we got 28 properties now or 30 properties now, I think. Sorry, it's 28 properties under our management. We have another, I don't know, maybe another 5 or 6 properties that are on third-party property management. So after owning currently 30 something deals, you learn how to analyze deals a little bit differently through operational experience, paying attention to your debt, paying attention to your cash flow net of escrow reserves and all of the other things. And it's not to say that you didn't pay attention to it before. I think it's just as you continue to grow and you see what's bitchy in the ass, really, you know what to look for a little bit better. You know what to pay attention to a little closer. You know what matters and what doesn't really matter as much, and you know which buttons to press. And that all comes from experience at the end of the day. And these are some of the ways that we are incorporating these experiences that we've had into our underwriting process and into our underwriting models, and giving the go or no go on going after a deal. And I've said it now for about 6 months, maybe even 12 months, but we're not in a position where we have to buy a deal. And that puts me in a really great spot because I can be selective about what I want to buy and when I want to buy it. And I am absolutely exercising that right now because there had been a handful of deals that had come up. And I am so thankful that they did come up because we have the capacity to take them on. And if we can get these contracts signed, I mean, these will be monumental deals for Tim and myself, and significantly change our futures, which is exactly why you want to be selective in your underwriting process and your acquisition process, so that when a good deal, a really good deal, actually does come across your plate, you have the capacity and the wherewithal to make sure that you go after it aggressively, so that you can change your future and change your family's future. So, all right. Enough of my rambling and my spiel today. I appreciate everybody joining. Hope you learned something. If you have questions on underwriting or questions on market information in North and South Carolina, we have stuff in Gulfport, Mississippi, and Mobile, Alabama as well. So, we're spread out pretty far right now and working on consolidating into North and South Carolina operationally, right? So, if you have questions, reach out. Happy to help. So appreciate you guys joining and see you next week. Peace.